everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. Our normal host, Robb Fahrion, couldn't be with us here today, so we have a guest host, Enrique Abeyta from HX Research, a fellow former hedge fund manager and research guy. Enrique, how was your week?
Well, just getting started, and I spent last week in Uruguay, South America. So there's been a lot of catch up. Let me say that. So busy start.
Wow, that's so your family is from there?
My mother was born in Uruguay. My father was born in Black Hills, South Dakota. But yeah, so first time since COVID, we were down there, and I had an 11 and 7 year old. So I spent a lot of time wrestling the kids around everywhere. So
How'd they like it?
they loved it. They loved it. They're great kids. So, everyone had a good time.
All right, good. I'm actually heading for South America soon, so I think we know one of the countries that's going to be moved up onto the short list.
It's a very chill country. So if you're looking for a place to relax, that's where I recommend you go.
Well, I work from everywhere, so relaxing environment and a lot of work, and I'll be happy. All good. All right, so this week we've got a great list of things to be talking about, but first we are bringing on our guest star because you guys liked him last time. We have Andrew Brown, DKI intern from the University of Tennessee. Andrew he's a huge contributor to the Weekly Five Things. He did a video segment a couple weeks ago that was really popular. So for all the viewers who watched and liked Andrew's video, congratulations. You are helping the career of a young person. You're doing a good thing. And so we have him back. Andrew, how are you doing?
I'm good. How are you, Gary?
All right. Are you back in Tennessee in class now?
Yes, sir. Beautiful day in Knoxville. Had a few classes this morning, then here today for the show.
All right. Good. So the reason we want to talk to Andrew today is to get his view on the economy from the point of view of somebody who's 20, right? Andrew, we've all heard your whole generation. You guys are delicate. You're snowflakes. You're entitled. You have no work ethic. You just basically lay around whining that other people aren't giving you things. You also have no knowledge of finance. Enrique, am I missing anything? Are there any other ways that we can generalize Andrew's generation?
Well, I mean, they're good at video games. How about that?
All right. So good at video games, but whining about everything else. That's the general view of your generation. But we have a different view on this at Deep Knowledge Investing. And the interns we've had have a very clear understanding of the economy. But I think the economy that we've had has been particularly challenging for young people. And, they say that, young people are whining too much. I think it's easy to argue that there are a lot of unique circumstances that are making life very hard financially for the young generation. Let's get your view. What's on your mind, and what's it like being 20 and trying to get started in business, in a career? What are you facing?
Yeah, thank you, Gary. Well, as you just mentioned, Gary asked and was like, go take a poll of your friends, see what they think. And so I took a look, asked around, and was like, hey, what do you see in the economy right now that's a big issue to you? And of course, the thing that came up was inflation. I mean, rent on a college campus is absolutely ridiculous. Food is really high still. And then another thing of kind of people looking down the road is, will I be able to buy a house in 5 to 10 years? And that's a sign that a lot of people around me kind of don't feel like they will be able to afford to buy a house. I personally feel like I should be able to, my given opinion, and that's a goal of mine. But a lot of younger people feel kind of like a doom of trying to accomplish buying a house. And so I kind of took like a more DKI look at the problem, and where this really kind of stems from is from government spending. I mean, the government's been spending billions and billions of dollars the past few years, and it's really just going up and driving prices higher. Inflation's much higher. And then also the past 10 years, interest rates have been so low, driving up home prices, making it really difficult for my younger generation to afford to buy a home. And then if we look at kind of the more government side of things, I mean, people can say this is a hot topic, but this issue, both parties heavily participate in excessive government spending. And right now, we have $3.8 trillion locked in as mandatory spending. And so if we're trying to cut spending, it's really, really tough for the government to do that if they've got $3.8 trillion locked in to the government that they can't even touch. Well, I mean, like the discretionary spending, like the military and that sort of thing, they adjust that and kind of debate about that. But in the end, majority of that number that's the issue, the government can't even touch without changing the law. And so just kind of my kind of approach to this, of this as being a bigger issue, we have to go upstream to solve this problem. And while the government, they could solve it, they could change the law. But really, if we can get younger generations to start saving, to start having a higher financial acumen than past generations, and start in the schools. I'm from North Carolina and I went to public school and I had a great experience. My teachers were really good, but was the curriculum that I was taught, was that really what's going to benefit me the best down the road? No, not in any way was it the best curriculum. And if we can just kind of start the source of this problem of teaching kids to save from a lot younger age so that we don't have as big of a social security burden down the road, that's where we have to start with this issue. And that is truly kind of the approach that we need to take. And as it kind of all goes back to, if we can get people to start saving, then the government, they'll be less reliant on the government to spend, creating inflation. And so in the end, housing prices will go down, food will go down, but it's a matter of taking action with that issue. Gary and Enrique, do you have any takes on that?
Yeah, first of all, Andrew, I give you a ton of credit, right? The Washington, D.C. has blamed everybody but themselves for inflation, right? We've heard it was Putin, it was supply chain, it was COVID, it's greedy companies, right? By the way, companies are only greedy when your party is in the White House. When the other party's in the White House, it's not, somehow the companies aren't greedy, right? But the truth is that it is massive amounts of overspending by Washington that's leading to inflation. It's not a coincidence that this happened after more than a decade of 0% interest rates and trillions of dollars of stimulus, right? They went the Ben Bernanke route. They went helicopter Ben, and we're literally sending out checks to every person in the country. Of course, we got inflation for that, but I give you credit for being able to see through it, because the government thrives on people's ignorance. They don't want to take credit for inflation, of course. They don't want to take the blame for it. So what they do is they give you a whole bunch of other evil people for you to blame. The fact that you can see through it, I think, speaks very highly of your analytical skills, and that's fantastic. I would simply add one other thing. It's pretty obvious to all of us that young people are not being taught finance. They're not being taught budgeting. They're not being taught to save and invest. They're being told literally as soon as you leave high school, what you need to do is go into massive amounts of debt, right? That's what they're all being told. The whole consumer experience is just buy everything now. You'll have debt, but who cares? No big deal. That's what people are being told. So Andrew, here's my question. Why do you think the school system, the public school system, is not teaching people these important skills that would enable them to be self-sufficient later in life? I think I just gave away the answer, but what do you think?
They want us to be relying on the government.
Is that what you want? Is that a good life for you? Do you want to be relying on the government throughout your life?
No, I would use a much stronger word to describe that, but
okay.
no.
So for the next person who says that all these young people are entitled and they have their hand out and then one thing's being handed them, here's a 20-year-old saying, I don't want to be reliant on the government. Let me work. Let me earn my own living. Get out of my way. Right? That's the opposite of entitled. Right? Andrew, how many of your friends share your views and attitudes on this, that where they don't want to be dependent, they don't want to hand out, they want to be responsible, they want to work, they want to make their own way?
95%.
My God. Maybe
95%.
we should be sending more people to the University of Tennessee. That is impressive. Enrique, what are your thoughts?
Well, I have a lot of thoughts. I mean, this is a big topic for me. When we started my prior firm, Empire Financial Research, I started with my partner, Whitney Tilson. We both came out of the money management business for 30 years. And the idea was to bring the experience and resources and networks that we had and bring it to what I call real people, instead of managing money for CalPERS or Abu Dhabi. How can we bring these ideas and this access to a doctor from Birmingham, Alabama, a lawyer from Seattle, just regular real people. And so that's really what HX research is about. There's another aspect to this that, and believe it or not, I'm working on a series of children's books that we'll talk about later. But the financial education of our youth in this country is an absolute travesty. It reminds me of sex education. 30 years ago, we didn't teach children anything about sex. It was completely taboo. You couldn't talk about it. Now you can talk to 10-year-olds about, fellatio. Like, it's like, oh, the tide has turned completely. But if you were to take a 10 or 11-year-old and try to talk to them about accounting, savings, compounding, rates of return, it's like, no, 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 no. You can't ruin their childhood by talking to them about finance and skills that can actually help them. But oh yes, you can talk to them about all these other things. And so it's a big thing that, we just launched our firm a couple months ago, but we're going to push hard on this. I'm actually taking my son, and I'm going to add another wrinkle to this. My son, who's 11, is a huge gamer. There's actually a new game on Roblox that's a stock market game. And, I think, and it's funny when I said that young people are really good at video games, I wasn't kidding. They're very good in a digital world. They understand the metaverse. They understand gamification. And I think that the best thing we could do for the youth of this country is educate them financially. The number one stressor in our lives is not health, is not family, is not sex. It is money. And we do so little / nothing to educate the young, the immigrants, the old about how to manage their money. And the reality is, each of us is a mini company, right? We've got income, we've got costs, we've got taxes, etc. So I think you touched on it perfectly, Andrew. I think that that's something, the single best thing we can do for this generation, the coming generations, is educate them financially on how to manage their lives. And again, control is an illusion, but influence is not. How can you influence the outcomes, and just feel less stress and better mental health by knowing that you're playing an active role in the ability to provide for yourself and not rely on the government to do it for you.
Definitely, for sure.
And by the way, I'm with you on the video game thing, and I see the benefits of it. I grew up playing video games, and especially the games that you have now. They are phenomenal for teaching things like resource allocation. That you can't have guns and butter. You have to make choices, and they're great for teaching risk control. Right? What's the strategy to attack this particular problem? In many ways, the skills that you would learn playing video games are skills that would be valuable as a portfolio manager.
Yeah, no, and I'll say a funny thing. My son right now is fascinated with military strategy and combat games, and we'll leave some moral decisions to the side. He's thinking strategy all the time. Like he's like, okay, if I do this, I'm do this, and that's what life is. Is life is a number of strategic decisions, risks and rewards, just like portfolio management. So no, I'm a big fan. I'm a big fan.
All right, Andrew, nice work on this. As
Thank you.
always, we're very impressed. Keep up the great work, and I will talk to you in about an hour.
Thank you, guys. Have a great afternoon.
All right, see you, Andrew.
See ya.
By the way, Enrique, I got to tell you, he is the 8th intern I've had in 4 years of running deep knowledge investing. Every single one of them, smart, worldly, understands finance at a level that I didn't when I was their age. Great work ethic. And every single one of them, people keep talking about these young people as being fragile. Every single one of them takes criticism and correction really well because they want to learn, they want to get better. I think they've all been admirable people. They've been, a terrific addition. And Andrew does amazing work, and he saves me hours every week.
Cool. Well, I need one like him. Send the next one to me.
We'll do it. You have Andrew's email. Get one of his classmates. 95% of his classmates want to work and make a living for themselves rather than be on government assistance. Grab one of them.
Yeah, there you go. Sounds like a plan.
We'll get you hooked up. By the way, Tracy Schuchart, who was a guest on here a couple weeks ago, she wants one of Andrew's classmates as an intern as well. So we may end up being the employment counselor for University of Tennessee.
Turn into a placement agency. Perfect.
Exactly. Yeah. All right. So Enrique, let's get into it. We heard from Andrew, but we've got the 5 things. Why don't you get us started here?
Yeah. So look, we'll go through these. I want to introduce them. The first one that's been a huge topic of conversation. I have CNBC back there on the TV. Is what they call the halving. This is in regards to Bitcoin, where the productivity of mining of Bitcoin is literally going to be cut by 50%. This means that it makes it much more expensive to produce incremental Bitcoin. And it means that the growth in supply of Bitcoin will slow substantially. There's a lot of very interesting ramifications. This is what I call a deep cut, meaning it's a very subtle issue, even though it's getting a lot of play out there. But let's start, Gary. Tell us what you think of the halving that is literally happening here on April 21st, 2024.
Yeah. So I believe it happened on Friday.
Oh, there you go. My bad.
Yeah, no, that's all right. Happened already. It's the 4th Bitcoin halving in history. So here's the way it works. There are people called miners that are using sophisticated computers to solve mathematical problems. And somebody will get the right answer roughly every 10 minutes or so. And when they do, their reward is a certain number of Bitcoin. And as of last Thursday, there were roughly 900 Bitcoin being mined every day. So every day, the supply was another 900. As of Friday evening, that just got cut to 450. So that changes your stock to flow ratio, which is just a fancy way of saying the number of new Bitcoin compared to the existing stock of Bitcoin is coming down. And the term that we use to describe that is saying that makes it harder. Something where it's very difficult to create new supply in relation to the size of the existing stock is considered hard. The opposite would be something soft like the US dollar, where somebody in Washington can push a button and there's another few $1 trillion. To give you a sense of magnitude, since Bitcoin since its existence began approximately, God, what was it, 14 years ago? Something like that. Roughly 19.7 million Bitcoin have been mined. That's out of a total of 21 million. And so that means 94% of the total supply that will ever be in existence is already in existence. The other 6% will be mined over the next roughly 115 years. And so as the halvings happen roughly every 4 years, the reward to miners will continue to be cut in half. So we just had the 4th one, that reward being cut in half is why it's called the halving. The last point that I'd add before getting your impression on this, Enrique, is the reason Friday's halving was significant is it actually made Bitcoin harder than gold. So typically there's a certain amount of gold that's been mined since the beginning of history. And it's roughly almost enough to fill an Olympic-sized swimming pool, just to give you a sense of how much or how little gold that would be. But every year, the increase in supply of gold is about 2%, sometimes a little more, sometimes a little less, but about 2%. And so we look at that and we say, okay, the supply of gold goes up by about 2% a year. That's pretty hard. It's hard to mine new gold. It's a lot of work. Well, as of Friday, Bitcoin is now roughly twice as hard as gold. The stock to flow ratio for Bitcoin is twice as good as it is for gold. And then in another 4 years, it will get twice as good again. And so that's why this matters.
Yeah, no, look, I agree with everything you say there. The one thing I would say is I feel like the halvings at this point are very small catalysts but they're important in the overall narrative. The reality is going from a 4% growth to a 2% growth is not a huge change, but I think the stair step functions in demand that we have seen and that we will see. And a stair step function is, instead of having demand go up in a line, it sort of goes like this and then jumps. I think they're huge, and I'll throw in, and not to change the topic from the halving, but just having come back from Uruguay, I think that the challenge that a lot of American investors have is they don't really understand the international aspect of Bitcoin. When we sit here and we watch CNBC and we think about America and Blackstone ETF and this, that, and the other, we're not thinking about Argentina. We're not thinking about Turkey. We're not thinking about the dozens of countries all over the world where people are looking at Bitcoin as a store of value that is far superior to gold. And that's not that gold is bad. It's just, it's a lot easier to transact in Bitcoin than it is in walking around with gold bars. So, we've been a fan. I honestly think that Bitcoin can go to 100,000. I think Bitcoin can go to 1 million. And again, because there's 500 million people or 600 billion people in the developed world, and I think we're very focused on that. There's 600 million. There's 6 billion in the developing world, and I think this is going to become more and more of a proxy for them. So I look at the halving as like a good quality quarter in the 30-year narrative of what's going to be one of the greatest growth stocks of all time. So I'm glad they got another good quarter, and it helps move along that narrative that's going to make this thing go up another 20-fold from here, in my opinion.
Yeah, and I like the fact that you're highlighting the impact on people who don't earn their money in dollars. It's really easy for Americans to say, what do you need Bitcoin for? We have dollars. But it's really easy for them to forget that most of the rest of the world does not get paid in dollars. And if you're in Argentina, Venezuela, Egypt, right now, large parts of the world have horrible inflation and horrible financial controls. I would also add one other thing. I think there's a moral case for Bitcoin. There's a huge civil liberties issue. We've seen in developed countries like Canada and Great Britain that theoretically make some sort of nod toward freedom of speech. We've seen people who have views that the government doesn't like, where they've just said, you can't have a bank account. We're freezing your bank account. Or, the banks have been told, if you serve this person, you're going to have regulatory problems. And so people, all of a sudden, they can't be banked. And what do you do? How do you get paid? How do you pay people? Where do you store money? You can't just store cash in your mattress and think it'll all be fine. Bitcoin is an option, and it's an option for people who care to express views that the government may not like. And, I would just suggest, like, if you're listening to this and thinking, oh, well, but the Canadian truckers were bad guys and I didn't like what they had to say, or, the guys in Great Britain, I didn't like their politics, it wouldn't happen to me. I assure you, at some point, the people in Washington will change. You'll have a different party in control. And some of the things that you think, and some of the things that you're comfortable saying, and some of your closely held beliefs will be unpopular at some point. And so free speech is for everyone. And if speaking your mind means that you can't have a bank account, the fact that Bitcoin exists, I think there's a moral case to be made for greater human freedom. And I'm very strongly in favor of that.
Yeah, no, I think it's a great point. It's a great domestic one, and it's a great international one. So, okay, for the second one here, last week we saw the new retail sales numbers up 0.7% on the month. This was well above expectations of the 0.3%, and annualizes to about a 8.7% increase in retail sales. That's not double digit, but in shooting range of double digit sales, retail sales. So, with everyone complaining about inflation, complaining about employment, with all the worries in the world, the US consumer certainly doesn't mind spending. Maybe it's stress spending, maybe they're spending their feelings or something like that. but I'd love to hear your take on what's going on here with the consumer and retail sales.
So I think it's a combination of things. You're right about people's feelings, and we're going to address that in a minute. But I think the first point you made, Enrique, is the key one. Um, so retail sales were up, as you said, 0.7% for the month, but the CPI, the Consumer Price Index, which people regularly refer to as the inflation index, that was up 0.4% from the prior month. So you could say, wait a minute, that's more than half from inflation, but as we've been saying at Deep Knowledge Investing for years, and as Andrew Brown, our intern, just pointed out, inflation is hugely understated. My favorite example, first of all, the housing prices in the CPI are ridiculous. They're calculated based off of what we are, owner's equivalent rent, rather than actual housing expenses. They're trying to tell us that food prices are up 2%. Enrique, I can't imagine you believe that. I don't know anyone who does. And so if the CPI is understated, then it's really easy to conclude that most of the increase in retail sales was actually due to inflation and not necessarily people buying more stuff. It's people paying more for the same amount of stuff. The other thing I'd add is the key point you were talking about, which is people's feelings. And in general, I think it's unwise to live beyond your means. I think it's a really good idea to have a budget and, not spend more than you're able to. With that said, it's really easy to understand why consumers keep spending. The government exercises no spending restraints. The government refuses to acknowledge there are trade-offs between program benefits and costs. We've seen bank bailouts. There are widely disseminated rumors about the government preparing for commercial real estate bailouts on the way. People looking at that have basically been shown there are no trade-offs for spending. The government will bail out everybody. They're bailing out student loan people who took out student loans. And so people are looking at it saying, wait a minute, why am I the sucker here? Why should I be living within my means when other people are taking on huge amounts of debt, huge amounts of risk? If it works, they get to keep it. If it doesn't, the government bails them out. The government has created a situation where people feel like suckers for exercising any kind of fiscal sanity or restraint. I think that's a bad idea, but I can understand why people feel that way. If you're listening to this, I strongly suggest living within your means. But for those of you who haven't, I completely understand why you might be frustrated or feel like the system's rigged against you. Enrique, what are your thoughts? How do you feel about this?
Well, look, I don't disagree with anything you said, but I'll take the other bright side of the coin. People have jobs, people have income, and the economy's growing. And, so like I agree with everything you're saying, but I think that, the growth in consumer and retail spending is certainly getting a contribution from inflation, but it's also in a high employment economy, people are gonna spend the money, just to be frank. So I think that, I look at that number. There's a lot of things, and we'll talk about this in a little bit. I look back to the 94-95 period, which is when I first entered into the markets, and, a period of stability after, and this is stable after a period of extreme instability, which was certainly the COVID and then the hyperinflation period. People are relaxed a little bit. So, I think everything you said is true, but on the positive side, high employment, even if it might be getting a little bit, a little bit less. People are there to spend. And don't forget, a stock market that's up 35-40% in the last 9, 12, 15 months is also another reason. So I think it's a combination of both positives and negatives.
Yeah, and you're right. It's worth pointing out that those consumer spending numbers are aggregate. It's not a median spending number. So people who do have investments, who do have money in the markets, have been pretty flush lately. And you're right. The employment numbers have been good. They've been faked, but people who want to work can be right now. They've gotten raises. And I know a lot of people have been highlighting increases in consumer credit, but the offset to that is that they're also making more money and there's been inflation. And when you look at consumer credit versus people's income, The credit usage is up, but the ratio isn't actually bad. It's not outside of historical norms.
Yeah. Yeah. Well, good. So that'll bring us to the next one. You mentioned here, you start talking about the buy now, pay later industry, which is just a fascinating sector. And I'm sure many of you out there in the audience are familiar with it, but this is where you go and you buy something on Amazon and all of a sudden it says, okay, that's $99, or you can pay $9.99 per month for, it doesn't really tell you how many months. You'll end up paying 10 times more. I remember this from when I was a kid. We would go to the grocery store and they'd have a couch, and the couch would be $400, or you could pay $40 now. They just didn't tell you you end up paying $1,400 for the couch. When all is said and done. So it's really just taking the layaway business of 30 years ago and putting it on the internet. And you show here a chart that shows the consumer loans, credit cards, and revolving lines going over $1 trillion, setting new all-time highs. What do you think's going on here, Gary, and what are the ramifications?
Yeah, so the buy now pay later thing, you're right. It people are acting like it's this new thing. But when I was a kid, mom would take us clothes shopping and you could put things on layaway. You give the store a little bit of money, they keep it in the back room, they put your name on it, you give them a little more money. At some point, you'd paid it off and would take it home, but there were no financing charges for it. And then, we started to get buy now, pay later a few years ago, more use of it. And people acted like it was something new rather than, the supermarket couch scam that you talked about. And at first it was kind of funny, right? We heard about people using buy now, pay later to buy a pair of jeans, right? Which gets kind of nutty, for $40 pair of jeans that was being divided up, you were paying it off over months. Okay. And then it got really funny when people started using buy now, pay later for fast food. Like you could put a Happy Meal on layaway, right? That got kind of nutty. But using it for rent is going to be a gigantic debt trap for people. The company that we looked at is Flex. I don't mean to pick on them. Well, that's not true. I do mean to pick on them, but they're hardly the only ones doing this. But, I watched their ads, and it's this, cartoon woman talking about how using buy now, pay later to pay your rent is about taking control of your finances. It's liberating. And that's ridiculous, right? What it means is that people are paying fees to not pay their rent on time. Now, it's one thing if cash is tight, and obviously bouncing a check is really expensive, missing your rent deadline, really expensive. Using something like this on an occasional basis to get through a tough time, sure, I get that. But the thing that Flex doesn't tell you in their marketing about how liberating it is and how, you can take control of your finances by going into debt. The thing they don't tell you, unless you read the fine print, and we read the fine print at Deep Knowledge Investing, is that if you don't pay them on time, they can charge you up to a 36% APR. And oh, wait a minute, this isn't really buy now, pay later. This is a debt trap with gigantic 36% interest rates on the other end of it. And so, listen, if you use it once or twice, fine. But if you think that's taking control, you're going to be surprised. And again, it's one thing when you can't pay the bill on a, Big Mac because you use buy now, pay later in a fast food store. When it's your rent, and that is your single largest monthly expense, and you are falling further and further behind, and then the interest starts to go up, you're going to have a gigantic problem. And I assure you that the people that you talk to at Flex when you're thousands of dollars in arrears are not going to be nearly as funny as the cartoon woman talking about taking control of your finances. They're going to want to collect, and you're going to have a giant problem.
Yeah, look, the whole thing is fascinating. We used to outlaw gambling, and now we, do billions and billions of dollars of it with publicly traded companies.
Right.
We used to outlaw marijuana, And now we do billions and billions of dollars of it with publicly traded companies. We used to outlaw, usurious lending, and now we do billions and billions of dollars with it in publicly traded companies. The only thing I'd say is that through time, there was a reason why gambling was illegal, a reason why marijuana was illegal, and a reason why usurious lending was illegal is because it really plays in very negative ways into human psychology. It's going to be interesting to see the way this plays out. I think that I'm going to say this will sound a strange way. The problem's big, but it's not big enough yet. But when it gets big enough, I'm going to tell you two things are going to happen. Well, three things. Number one, the government's going to step in and put in more regulation, whether that's good or bad. Number two, I'm going to tell you that there's a bunch of these companies that are actually not profitable that will go out of business. Think of it as the equivalent of what happened with WeWork. There was just a non-economic model. And number three, I'm not going to be surprised to see another government bailout. I'm not saying that's good. I'm not saying it's bad. I'm just telling you it's going to happen. Look, the clear advice, avoid BNPL whenever you can. The simplest advice to give anyone always is pay off your highest debt, cost debt first thing. I like, skip a coffee if you can and pay off your 36% debt. But what I do think will be interesting to see is how this develops across the next 10, 20 years as this business, begins to grow and mature. So,
yeah, I'm completely with you on this. For what it's worth, I'm actually okay with things like gambling being legal, lending being legal. If people want to use marijuana, I don't like the government being in the business of telling people what they can and can't do. They've historically been horrible at it. I don't think these businesses should be illegal, but I think the people listening to this should be really careful about using it. And Enrique, I liked your conclusion on it, which is don't use these services. The BNPL businesses shouldn't be illegal, but consumers should avoid them.
And I guess let me get back to what you said. I agree with you too. These should be legal businesses. I think we're going to end up, and I'm not the biggest fan of regulation, but we should end up with greater and more rigorous regulation in all of these. And I think we will. I think we've got a gambling problem in this country. We've got a marijuana problem in this country, and we're going to have a bigger and bigger BNPL problem in this country. So just the same way we put laws around alcohol and tobacco, there needs to be more rigorous regulation here. And I'm the most hardcore libertarian guy you're ever going to meet. So it's that means something when I say that. So
wow. So we've got two libertarians on the show telling people more regulation is coming and don't use this stuff.
Yeah, exactly. So the next one here, we've been talking a lot about credit. You point out a chart here that commercial bank credit, which is the loans that banks make to businesses, has really topped out here. Once we entered into 2023, which I'll note is right after the big spike in interest rates, you really have seen the level of commercial bank credit level out at about 1. I think this is in trillions, or is that
17.5 trillion or so.
$17.5 trillion.
Yeah.
What's your, look, this is another subject that could be, I don't want to call it nuanced, but there's a lot of takeaways that could be taken from this. Some of them are subtle. What's your view? What does this mean for folks?
By the way, I think that's the right way to frame it. I have a view on it, which I'm going to share, but I readily acknowledge there are other people who could look at this data and draw different conclusions and make strong arguments on the other side. And to the extent that any of you listening to this have a view, you think we're wrong on it, or I'm wrong on it, put it in the comments. Love to hear from you. This is one of those things where Enrique is right. It is nuanced, and there are smart people who will disagree with me on this, and that's totally fine. Give me your view. Love to hear it. So we, in the previous segments, we're talking about increasing use of consumer credit, and it's true. And Enrique's right to point out that, yeah, it's more credit usage, but it's also on higher employment, higher incomes. That's a fair point. On the commercial side, I'm looking at a chart right now for almost 2 years. It's been flat. And what that's telling me is two things. One is that the private economy is not growing, right? That's the thing that when businesses are growing, they go and get credit so that they can expand. And we're not seeing that. And so what's the second point of it? The second point is, and we've talked about this on the 5 things and at least twice so far this year, is that the GDP numbers are being faked, and they're being faked by the government. And just another reminder that government spending adds to GDP, gross domestic product, whether it creates value or not. And so as the government spends more and more and becomes a larger and larger part of the economy, I think what we're seeing is that government spending is flourishing, government employment is flourishing, government use of credit is through the roof and has gone parabolic. We're in the ludicrous part of bread and circuses now. But the private economy is struggling. And that's what I'm seeing here. And so when we get, I think it's later this week, we get the first quarter GDP number. When we get that, it is going to show a positive number. But the last quarter, what we saw was increase in government debt exceeded the increase in GDP. In other words, government spending has a negative return and it's pushing out private market spending. And I think that's what we're seeing on the commercial bank credit graph that, will flash up on the screen. Andrew will make sure it goes up there. That's my take on it. But again, I acknowledge other people might look at this and draw a different conclusion. Enrique, what are you seeing when you look at commercial credit usage and the economy as a whole?
Yeah, look, this chart is very highly correlated to interest rates. We went from free money to not free money. Interest rates went from 0 to 5 on the short end of the curve. And if you were to plot the level of interest rates over this, you would look at the velocity. And I think there's just a lot less people are interested in borrowing at 5. I'm using again the short end of the curve than they were at 0. The other thing is, I think if you look at the aggregate amount of debt that was issued in the course of 2020 to 2022, it was massive. People I credit actually to hundreds and hundreds of CFOs and controllers. They were like, free money, sign me up. So, I struggle. It's funny. I agree with all the stuff you're saying about the government spending, buttressing the economy. I don't know that I personally read anything into the private economy about this. The other reason, too, is that this commercial credit really addresses larger enterprises. Smaller enterprises make up a much smaller portion of this. So, I think if this were to persist for another 18, 24 months, I'd start to make real reads about the economy. And this is not me disagreeing with your other points about the government. I just think that, we're looking at a period where with zero interest rate ZERP, zero interest rate policy, large corporations borrowed a crazy amount of money and took advantage of it. And now they're just sitting on their cash because they're profitable. It's not like they're losing money, they've got cash flow to invest, et cetera. So I kind of put this as a push for the economy as opposed to either a negative or a positive. So this is where we agree on a lot, but maybe the nuances are different. So look, let's bring it to the final one here, which I think is a really popular one. Or at least there's a lot of anecdotes here. And this has to do, the headline you have here, tech companies reducing office footprint. But it really has to do about commercial real estate, urban commercial real estate. We saw a news item, some building, I'm going to get this wrong, maybe in St. Louis or Oklahoma, sold for 200 million and just sold for 20 million or 6 million, some crazy numbers. You're seeing, you have the number right here, San Francisco office vacancy rate at 36.7% in Q1, down from 3.6%. I think with everyone still, even though it's 15 years later, feeling the scars of the housing crisis, this is getting a lot of mind share in the media and a lot of people talking about it. Look, what's your take here, Gary?
So this has been a continuing series. I think every week on the 5 things for the past month or two, we've been talking about issues in commercial real estate. And you've correctly pointed out that doesn't mean we're going to have a 2008 style disaster, and that could certainly be the case. And I agree that there's less leverage in the system now than there was then. With that said, there are a couple things going on. First of all, the tech firms pre-COVID were actually buying or renting office space defensively. They were intentionally taking on more space than they needed because they thought they would grow forever. Not only has that stopped, it's actually reversed. And the reason for the reversal is, one, they have fired tens of thousands of employees. They've reduced headcount. And two, work from home, work from anywhere. And tech employees are probably better equipped to work from home, work from anywhere than any large company employees in other fields. Technology it lends itself really well to being able to work from Uruguay. And I do that. In finance, I work from everywhere. I work from many different countries. But that reversal here, where we're looking at vacancies in San Francisco up 10x, that is a huge problem. And I can assure you, a 3.6% vacancy rate in 2019, they're thinking fantastic. This is amazing. At 36, 37%, you end up losing your equity value. Keys end up being sent back to the mortgage holders. So, the takeaway on this, I think, is to acknowledge on the positive side, Enrique's point, which is there's probably less leverage in the commercial side of the business now than there was in the housing market in 2008. But on the negative side, in 2008, housing demand didn't disappear, right? People, valuations went down, and a lot of people handed their keys back to the bank. But we didn't lose people, and the people who existed didn't lose an interest in having a place to live. That's not happening on the office side. The demand for office space is decreasing, and it will be many, many years before it reaches 2019 levels again. And in the fight between boomer age bosses who want people to be in the office, FaceTime, be physically present, and the younger push toward work from anywhere, it's very clear the work from anywhere people are winning that battle. Not every time, not in every space, but it's going to be years, maybe decades before the demand for office space is what it was. And that we didn't have happen in 2008. In 2007 and 2009, the valuations of the housing market moved, but the number of people who wanted to be in a house was exactly the same. That's not the case with office space. And I think that demand is, if not permanently impaired, it's impaired for the foreseeable future.
Yeah, I agree with you on all of that. I think that where, so I'll say this a different way. I believe that the demand for Class B and C office space in urban areas, as well as suburban areas, is permanently impaired. Now, what does Class B and C mean? Older buildings, just not as new, not as nice. It's just kind of the second tier. Imagine if we were to do the housing example, it's the houses that are in the not as nice neighborhoods and that are a little bit older, et cetera. And I don't think it's ever going to recover. The question is, for me, and you're not saying this, but the media is saying this, and a lot of talking heads are saying, is what is the materiality? In the housing crisis, we had millions, tens of millions of homes that were involved in that process. And there were thousands of lenders. It was a very complex ecosystem. It made up 10, 20, 30% of the housing stock. The reality is the truly impaired, and I'm going to tell you where I'm getting my information from here in a second, the truly impaired percentage by square footage in North America is maybe 5, maybe 10%. the CEO of SL Green, that's what I was looking when I'm looking over here. I'm looking at my Bloomberg, just so
Yeah.
everyone knows. I'm not checking the sports scores, the Yankee score, but SL Green was on, and he's like, they're at their 2019 levels. So I think that I agree with everything. I don't think it gets better. I think the materiality, though, is being misjudged. We always there's old Wall Street saying, we're always fighting the last war. The last war in housing crisis was a huge swath of the economy, affecting tens of millions of people and millions of pieces of property and thousands of lenders. This isn't. It's a relatively narrow swath. And this comes to the final point, and I think this will resonate with you. The markets are fixed. The markets are rigged. We wrote a report about this a couple months ago. They're rigged to survive. And so you have a situation where these buildings, they clearly are worth in the open market less than much less than where the loan is. But the bank doesn't want the loan. The person who owns the building doesn't want to put the loan out there. And there's no reason they really have to. And the government doesn't want it to happen. So you basically have all of the involved parties. The only thing that exists is a contract. And that contract can be renegotiated. It needs to be renegotiated in the context of bank lending ratios. But I think what you're going to see, I think this is a relatively minor problem for the overall economy. And by the way, I think I am absolutely confident that they're already working on it. That the Federal Reserve, and again, I'm not here to make judgments. I'm just here to tell you how things work. The Federal Reserve is putting together a group of banks, a group of lenders, etc., to act as a backstop to take on the worst of these loans. They'll loosen the bank lending ratios. I know, and I'll tell you where I'm getting all this from is, I went to school at the University of Pennsylvania. I have a half a dozen buddies who run real estate funds. One of them runs one of the largest family office real estate offices in New York City. They're like the number 3 real estate holder. Another one of them runs like a $30 billion fund. They're not bearish at all. They're literally sitting there saying, we're sitting on tens of billions of dollars waiting for these buildings to clear. They were bidding on the Silicon Valley Bank assets, et cetera. So that's a long way of saying, I think these are real problems, but there's a lot of things that can take down this economy. I do not think this is going to be what it is. And again, that's not what you were saying, but that's what the media is saying. And this is where we have at HX Research a very contrarian take. And again, when I say contrarian take, it's not because I'm so friggin' smart, but I know a lot of really smart guys that are doing a lot of business in these areas, and I listen to them. And this is what we're hearing from them. So a real concern, but there's bigger fish to fry. So
I agree with you on this. I don't think that commercial real estate takes down the economy. I don't think it creates a widespread crisis. But what could really create a problem is if the government bails out the lenders again. If they bail out the banks again, people are going to be angry, right? Because, in general, Americans tend to have short memories, but everybody of a certain age remembers how angry everyone was in 2008 when the banks got bailed out. They do that again, just 16 years later, I think people are going to be angry, and that could lead to real issues.
Can I give you one thing to think about, though, that people aren't talking about? Federal Reserve's got 500 basis points of rate cuts in front of it at some point. So this will all end badly at some point. But remember, you raise rates by 500 basis points. It means you got 500 basis points of rate cuts and stimulus to come at some point. I'm not some Pollyanna, but there's another side to that coin. So I think that you're absolutely true, and I think it builds to a crescendo through time. It's the reality of what happens in people's anger and perceptions about it, and when that meets the reality. And I'll say this one last thing: people got to show it in their voting. People aren't voting for politicians that are going to do the things that you're saying they should be doing or that they want them to do. They're voting for the status quo, and the status quo is going to be to bail these banks out and to cut interest rates down to zero again. And, until we see a real change in the willingness of voting to change that, I think we're going to continue to see more of the same.
All right. So Enrique, it sounds like your view is that higher for longer means higher for longer for inflation. So the question I've got for everyone watching this, is your portfolio prepared for higher inflation? If not, give us a call or check out Enrique's research at HX Research. For people who are interested, how can they find you?
The best place, you can follow me on Twitter at Enrique Abeyta, ENRIQUE, and at HX_research. But the really best place, we have a free daily email, comes out every day, several pages, daily.hxresearch.net, daily.hxresearch.net. You can sign up for free and get access to a ton of our stuff.
I read it every morning. It's a great piece. It's I make sure I've read everything you've written before the market opens.
That's why we publish it at 8 a.m.
Perfect. All right. Well, we will put a link to your to HX Research in the comments here. Sorry, in the description. For everyone watching this, thank you so much. We know your time is valuable. Really appreciate it. If you like this video, feel free to like and subscribe. We'd love to keep producing more of these for you, and wishing all of you a good week. Look forward to seeing you next week with a new 5 things. And Enrique, thank you so much for being the guest host. Really appreciate it.
Appreciate the opportunity, Gary. Take care.